Okay, any question regarding last lesson, please? If you have, we can discuss first. Okay, so if you have any question, you can ask. So we can go through first. The video slide and we'll start. And I'll share with you the book as well in a minute. So today lesson will go through LO2, learning outcome 2, and all the resources in a minute. So during our last lesson, I mentioned you will look around some investment appraisals, and we go through a bit recap on those, and we'll discuss, the okay, how's weather your end? Here in Leeds is nice sunny. Hope so you had a nice sunny weather too. Okay, just one more minute. We'll get the slides. Okay, welcome. Let's, we'll start. Okay, so thanks for joining. I'll go through slightly, so which will give you separate slides for investment appraisal. So last lesson I mentioned we can do numericals, yes, investment appraisal. So that was, we discussed about NPV, when is a positive, we accept the project, when is a negative, we reject the project. So normally NPV, when we calculate, so we have how much money we are investing in the business. Let's say that money is going year not mean current year. Then you always have, when you invest money, you either, if it's a machine, maybe you're saving due to the new machine, that's mean money coming in, you're saving, or you getting the cash inflow, that can be inflow. So that was outflow and that's inflow. So we getting 20,000, 40,000, 80,000. And always we use NPV or PV table. PV is called present value table. Formula is 1 divided by 1 plus R. Do we know R is a discount factor? Sometime we discount based on, if we will say 10% is a depreciation or the cost of capital, so we can say 1 divided by 1 plus R. Can you do 1 divided by 1 plus R, please? What answers will come on your calculator? You can use it. Yes, 1 divided by 1.1. Yes, when we'll say 1 is in formula, 10% mean 0.1. And if we do, what answers will come? So it's come your answer 0.909. Yes, if you do rounding. Yes, you're right. Well done. So that's your 0.9. Whatever answers you have, 0.909, whatever on your calculator, if you carry on dividing with 1.1, next year will come 8.26 approximate. So it means £1 value in a 1 year will be 99 pence if 10% depreciate. Year 2 will be 82 pence. Year 3 will be 75 pence. So if you're getting 2,000 pound, 20,000 pound, actually 20 times 0.909. So you're getting 18,180 pound in the real value of the money, because the value of the money is dropped. So we can look around in year 2 times by with the discount factor. We have a discount factor tables as well given in the book, end of book, and add them online as well. It's called PV table, present value table. We can say 10%, we can pick it. You can calculate yourself. 1 divided by, if it's a 20, we can say 1 plus 0.2, which is mean 20%. Yes. And that's the way. When you add all the positive numbers and the money you invested, if your positive numbers higher than the outflow, we can say NPV is a positive, accept the project, otherwise you reject the project. Is it okay? Yes, that's the one of the method is called NPV, net present value method. That's we discuss in the. Okay, great. Okay, then next we can look around payback period. Let's assume you're investing £3,100 in the business, and year 1 you're getting £1,000 back. Year 2 you're getting 900, 800, 500, 500. So 3,100, how long will takes to cover? So we can make a cumulative column. It's called cumulative cash flow. We outflow is 3,100, inflow is 1,000. So outflow left to cover is 2,100. If you're getting 9, it's left 1,200. If you're getting 8, 12 minus 8, other way around. Yes, so we can say 400 outstanding. In the end of 3 years, you have £400 outstanding cash flow divided by the following inflow. So we can't say the 4 year this project will take, because in the 4th year we are getting £500. Outstanding was 400. 400 divided by 500. In a years we have 12 months, so we can time by 12. So we can say this project will take 3 years and 10 months. Yes, that's our payback period. So if other project 3 years, 5 months, so that's the shorter is the better. That's we discussed in the previous lesson. So that's the way we can calculate the payback period. Is it okay? Yeah. The money we invest, the money we get, the difference is, yes, it's your how long will take you to cover your initial money, what you invest. So that's we had a payback period. Okay. Then we can look around ARR. So we can, let's assume we have 3 projects in this example. I'll send you these examples in the separate slide. Okay. So we have Handover, Bristol, and Carlisle, these 3 projects. If year 1, you getting, let's you invested 4 million and you getting 1 million back, 1 million back, 1 million back, 1 million back. So in 5 years, you getting £5 million back. You invested 4 billion. So your profit is 1 million. 1 million is your profit came in how many years? 5 years. So 1 divided by 5, your average profit is 0.2. So average profit divided by initial investment, 0.2 divided by 4 times by 100. So your return is a 5%. So we do exactly the second years, the second project and third project. So in the third project, which is a Carlisle, we investing 5 million. That project required 0.5 million. We are getting in year one, 1.5 year two, 2 in the year three, and 3. So total add them 0. So that's 2, 2, 4, and 3 is a 7 million we are getting. 5 million we invest. So 7 minus 5 is 2 million is our profit, but that profit is came in 5 years divided by 5, average is 0 0.4, 0 0.4 divided by 5 times by 100. So we are getting 5% our average profit a year. So that's the formula, is average profit per year divided by initial investment time by 100. And we can look around which project. So in A, B, C, Android, Carlisle, and these are the three project option we have. So is we are getting in project C 8% return. So C is a better than A and B. But if we don't have a 5 million to invest, we have only 4 million, then we can look around project B is a better, because early years you're getting more return and the later years you're getting less return. But average you getting both 5%, 5% A and B project. So that's the way we can appraise and we can decide which project is good to go ahead for the investment. Any question? Is it okay? You get me, please? Okay. So today lesson is we look unit. Okay, brilliant. So LO2, be able to advise on managing financial risk. So we said in the previous lesson, risk mean probability. It's the chance of happening. High risk, high return. We use the word beta, high the risk factor. Use the hedging. Hedging mean is a protection against foreign currency. We can hedge fund, maybe we heard about, like, because the currencies always fluctuate. Like if we have we make the payment dollar and pound, we can look around the currency, we can get the service from the bank, whatever the exchange rate, we can fix it, and that can we hedge. So we can look around the factor affecting the granting the credit and advise the organization management gearing mean, the high risk, high gear, high risk. Okay, advise using hedging instrument to manage the currency of hedge. That's we'll go through. We can look around when we do the treasury function, responsibility, cash liquidity management, capital market funding, corporate financial management, risk management, treasury operation and control. So cash management, currency management, that's a hedge. And we can look around the fluctuation of that, and investment management and corporate management. That's all come under the treasuries. Okay, foreign currency risk, also known as the exchange rate risk or the currency risk. Foreign currency occur where there are the cross-border operation involve more than one currency. It is the financial risk which is posed by exposure and anticipated the changes in the exchange rate between two currencies. So type of transactional risk can be occur when the company buy product and services in a different currency as receive in different currency than the operating currency. Yeah, so that can be a risk. So the transactional risk occur when the company financial statement reporting affect by the exchange rate. Like, you're dealing with, but actually your figures representing in the pound, so you have to convert them into pound. Then of course, sometime we look, come on, we don't have a profit. So that's a transactional and translational risk. Okay, economics risk occur when the volatility of the market, exchange rate market, can be caused at the change of the market value of the company. So the value of GDPs and all, and the inflation also affected. Type of the foreign currency transaction risk occur when the company buy in the product in different currencies, yes, in different countries, have and receivable in different currencies, operating currencies, and sin payable or the receivable denominated in different currency. The exchange rate at the stations of the transactions, which we can look around transaction of the date of the settlement, or maybe change due to the volatility in the market. Oh, the currency become better. Like if the pound is stronger, people go for holidays abroad. If the pound become weaker, then of course people maybe prefer to the local uh, within the UK to visit, the sites. Yes, but maybe we can attract foreign tourists to come here. This can cause the gain and the loss for the company, depend on the direction of the movement, exchange rate, and that's posed to the risk. Okay, so types of foreign currencies risk is can be translation risk occur when the company's financial statement reporting affected volatile, and then the large multinational generally have the presence in many countries, and each subsidiaries report their financial statement in that current currency. Then your consolidated group statement you can prepare into your one of the currency. The parent company and generally report the consolidated and include translated foreign currency, different subsidiaries in domestic currencies, and this can be hedged, this can be huge impact, and we can hedge them again foreign currency if we are dealing with the payments and trading. So the balance sheet and income statement can ultimately affect the stock price of the company and the type of foreign economics which we mentioned. Economic, the companies face economic risk. The volatility is the exchange rate market can be called as it changes in the market value of the company, and it basically represent effect of the exchange rate movement in revenue and the expense, which can be more or less operating cash flow, which we can look around, and the present value of that cash flow. So managing, we can look around transactional risk. It can be managed by hedging strategies such as the forward or the future or the options, which we can use instrument, which we can look around translational, which we can risk, difficult to hedge. The control involve the balance sheet items such as the long-term asset and the liability difficult to hedge due to the long-term nature, and uh, economics, risk also difficult to hedge as it complicated quantify the risk into hedge. Okay, managing foreign risk, like we can look around. Let's look, the currency pairs. We can look around. Pound and dollar is 1.49, and then so we can look around the purchase and the bid and the offer price, that's carry on changing. The market makes buy the base and market makers sell the base. Okay. The a derivative is an instrument that is a contract is one whose value and other characteristic are derived from those and other asset instrument called underlying, like interest rate, the largest foreign exchange, credit, equities, and commodities. Derivatives, which we can look around the fixing the instrument, the sales and the purchase of the fixed price, the future and the forward, like many energy company they earn in millions due to the gas electricity prices when, but they have a contract for the future in, so their price not increase, but actual the new price is different. Fixed and the floated interest rate, premium paid, the flexibilities and enjoy the price rise and fall and no obligation to buy or sell, or fixed float interest rate. Swaps, which we can no risk taken, and the principal is the key, and the forward contract is a forward contract often shortened just the forward, and the contract is the agreement to buy and sell. Contract is there is offer and acceptance, we call in the technical language is a contract. So forward contract is referred to the underlying the asset which will be delivered on the specific date, and consider the type of derivative and how the parties to buy forward contract and entering into the long position, and the parties selling forward contract into the short, the position. And if the price underlying asset increase, long position benefit, and if underlying price decrease is a short position benefit. Is forward contract example, the money in the current, your money in the currently in US dollar. However, 1 year ago, the time you need to be make the purchase amounting 100,000 euro. The spot rate is today is 1.13 US dollar, and however, you don't want to be the cash tidy up in the forex for a years. You want to be guaranteed that exchange rate for 1 year. However, are so entered into the forward contract of 100,000 at 1.13 US dollar at the date, the maturity, the spot price is 116. How much money you have saved, the difference between these, two figures, you can say you have saved that money because due to the forward contract. So you're supposed to be 113,000 instead of 116,000. So 3,000 you saved it through that. Okay. Any question, please, if you have? Welcome. Okay. Let's move to the next factor affecting the granting the credit. So of course there are a number of factors we can look around. Credit evaluation and the approval process. So we normally teach the credit management subject, Yes, please. Which question? If you have question, you hedging. Okay. Hedging is mean protection against foreign currency. Yes, foreign currency. For further, yes, forward contract. So we can protect it. So we can hedge it. Yes. So we can get the guarantee from the bank. Doesn't matter is increase or decrease. You pay the fees. They charge the fees. Okay, so we have a credit management subject, which is we look, either we grant the credit and we lend the money or not, based on the various factors. Yes, agreement of on the interest rate and on exchange rate, not interest rate. Exchange. So doesn't matter is go up and down in the term of the foreign currency, we can fix it the price. Yes, they will make the payment. Doesn't matter whatever the rate will be. So granting credit and lending credit, ability and willingness to borrow in return. So that's, we do the credit check, of course, the credit check approval, fund from the lenders, investors, vendors to grant the credit, approval of the credit. Factor affecting the credit risk, define the amount of the risk, in the business willing to accept. We want to give the credit, how much risk, we want to accept it, at which rate we want to give the credit. So based on the number of factors, we look the ratios of the company, we look the performance of the company, we look the future business, we look the market, and then we can decide, how much credit, what credit terms we'll decide. Yes, and sometime we'll get the reference from the third party, expected how long, and the payments will be. Credit policy, it depends your organization policy you can set based on the number of factors, application submission, all the past and the due, your business, whatever you do. Probability of default, if the probability of default is high, like in some companies due to the economic circumstances, corporate bond, higher correspondence with a higher rate and a higher required, the payment on the loan. So we can look around probabilities and we can look around the bad debts in the industries and we can decide, in the credit policy we can develop. Okay, loss of the given default extend to the loss for the financial institution, collateral on the loans, and the legal ability to pursue defaulted fund through the bankruptcy proceedings. Like, if you're supposed to be receive money someone and that person is not paying it, you give to the debt collector, you can sell it, and then of course, you can get some money from the debt collector, and debt collector will collect full money with even interest and extra fees from the client. Okay, exposure of default agreement of the total loss exposure of the lender is exposed at any point in time. So a factor affecting credit risk, define the amount of the risk in the business is willing, the credit term which we can look around, and credit policy, extending credit for application submission in the past due to it. So these are all the factors which we can keep in mind to grant the credit. Okay, always type of the business, which business you are in. If the property industry is in this, or the mortgage or the base rate is increased, these are all the factors we need to be keep. Fast moving good, prefer to compare the high inventory businesses. Start of the business less preferred as they're compared with the established business. Yeah? So financial performance, revenues, and the profitability ratios, balance sheet assessment, outstanding loans. We can look around liquidity ratio, default payment, high working capital requirement, which is we have the joint fund. Okay, next we can look around. If you have any question, you can ask. We can move to the next. Advise the organization in managing gearing. What is the gearing? Gearing is mean, the ratio between debt to equity, and we have two formulas which we use, to calculate the gearing ratios and the financial ratios, which we'll go through in the next lesson when we'll go through the financial ratios as well. Financial gearing concept is refer the relative the proportion of the debt and equity used to support the operation. We said, debt is cheaper than equity in the previous lesson because the debt, if you have a debt, you pay interest on it, and the interest is your expense of the business. And then, of course, if you minus the expense, you profit less, you pay less tax, and you can save it. But when you borrow money through equity, the shares and the dividend we paid after the tax amount what left here. So information can be evaluated the risk of the failure, reason for the gearing. Owner don't want to be dilute, its ownership or the debt, is only the because we don't want to issue all the shares to give the power to the shareholders. They have a voting right, they can change. Yeah. We need to look around acquisition can't be raised, sufficient cash. Then we can look around return on equity, what is the level of, and we look the back shares invested and capital expenditures, capital expenditure and revenue learn about if you extend your house, the value of the house will go up. That's your capital expenditure or any money you spend to buy the asset. Okay, then we can look around why debt financing. That is usually cheaper than equity, low risk, tax relief, and so we want to be expected, the increase, the proportion of the debt, and we can look around the weighted average cost of capital. We can reduce, increase the level of debt. Equity is more risky, and we can look around the firm commitment paid, before the equities and the financial. Traditional theories of gearing, we have a lot of theories. It's concluded, they should have an optimal level of gearing where the cost of capital is can be minimized, but it does not, tell where the optimal levels. It's a higher the gearing, equity holders become, increasingly concerned, increase the volatilities of their return due to the debt. That's also affecting, people maybe not buy the shares, and the share value can be dropped as well. So we can look around these all the factors, So at very high level, gearing, serious bankruptcy risk can be. We can look around traditional theory, cost of equity, cost of debt, which we mentioned in the previous lesson, and overall cost. We can look around the capital structure, static theory, trade off, theory with one things to trade off others. So we look around, tax versus debt at the interest, tax at the, so we can maybe, if it's a very high interest rate, and then of course, we can trade off one another, the benefit of debt and benefit of equity, and that's, which we can measure off. Static trade off is argue that the firm is established static position at just current level of gearing, achieve the target level, and we can look at gearing value of the firm, not optical. Financial distress can be agency cost, which is because agent and agency, which we can look around. And the target, debt ratios we always keep in mind. Marginal value of the benefit debt are they still greater than the cost associated with the use of debt. That can be debt. It's also impact on other ways. People think they're not investing because the company has very high liability. So from increase their debt. So one of the picking order theory state in the firm have to be preferred the hierarchy of the finance. Look on internally generated fund debt and the new issue equity. The implication internally generated, like you sell one asset, you buy other asset, or you can pledge. Okay, the value of the projected, depends on how the finance, and some project will be undertaken only funded internally, and the company has less cash, and the higher gearing will be more prone of under investment. If the firms, we can also look around when we have investing in capital assets, so you can claim, capital allowance from the taxman. That's also benefit which we can keep in mind. Okay, if the following gearing ratio is a result of the series of implemented decisions, not of the target ratios in mind. In equity, issue depends on the degree of the information, and maybe we don't have authorized capital registered in the company house. Okay, selected the long-term target gearing, while the target of the decision is governed by the static trade-off theory, and when targeting and picking theories, these are all the theories look around the fund, and that's the key today we discuss about risk. Risk is the probability of having and gaining. There are the two formulas: non-current liabilities divided by equity plus. Because when you borrow money for the long period of time, yes, I am going to send you. Okay, I'm going to send you, and I'm going to share with you the booklet first. If you give me 1 minute, I'll share. Sorry. Okay, so here is, I shared with you that. I'm sharing with you F9 book in 1 minute. So yes, did not deliver to you. Share on the WhatsApp. Sorry. Image. Okay, so so I shared with you these books, please. It's quite good. I can show you quickly from here. Hope so you can see it. Okay, guys. So this is a financial management book, integrated books. All the topics will cover here. Okay, so we're looking investment appraisal techniques. We're looking risk hedging. So anything you want to find, interest rate, foreign currency risk, exchange risk, yes, all given. So if you want hedge, that will take you straight to control F. Yes, this is a PDF format and this is an answer. So you have a workbook, you have an answer book, and you have a question books. Yeah. So in when we do assignment, even we can pick examples from these as well. But if you want other uh, like hedging and Kaplan, yes, so you can find the chapter of the book from the Kaplan this whole thing as well. So I shared with you. So that's different technique and different scenarios. You know, but examples from these, and that's what. Okay, any question? Thanks for attending to this session. And if you have a question, please feel free to ask. And otherwise, I will go through next week LO3 and then we do assignment discussion. Thanks for attending this session. Have a lovely weekend. Enjoy weather. Have a nice Easter. Yes, please, you can. I shared with you the links, yes. And of course, you can send me email as well. I'll make sure I'll update on this laptop because my email is being set up for the email. So I'll make sure I'll have university.co.uk. And just 1 second. Okay, guys, those are listening. If any question, you can drop email.